Imagine waking up one morning to find that your government has hit its spending limit, meaning they can't pay their bills, or worse, they have to make severe cuts. Well, this is the reality behind what's known as the debt ceiling crisis. And the consequences? They're not just felt in Washington, they directly impact you, your savings, and your financial future. Welcome back to Wallet Vision. Today, we're diving into a topic that affects your money more than you might think. The debt ceiling. We've all heard about it, but few understand how it works or, more importantly, how it impacts us on a day-to-day level. If you've been feeling the effects of inflation recently, this topic ties in more closely than you may realize. What is the debt ceiling? The debt ceiling is essentially the maximum amount of money that the US government is allowed to borrow to pay its existing bills. It's like a credit limit on a credit card, but instead of the government using the money for new projects, it's paying for bills they've already committed to. Think of it this way. Imagine you've bought a car, signed up for a mortgage, and have student loans. The debt ceiling is the limit on how much the government can borrow to pay off those existing bills. Without a debt ceiling, the government could borrow unlimited amounts of money. While that may sound tempting, unchecked borrowing could lead to inflation or even a financial crisis. The debt ceiling ensures that the government's borrowing is regulated and doesn't spiral out of control. But it does create risks if political leaders can't agree on raising or suspending it. The debt ceiling isn't a one-time issue. It's something the US government regularly runs up against, especially when they need to fund ongoing programs like Social Security, military expenses, or emergency relief during crises. Historically, Congress has raised the debt ceiling dozens of times. But that doesn't mean it's a simple process. Every time it happens, the political tension rises, with leaders arguing over how much to borrow, and often whether to make cuts in other areas of government spending. Whenever the debt ceiling is reached, it often leads to heated debates. On one side, you have politicians who believe that raising the debt ceiling is necessary to keep government operations running smoothly. On the other side, you have fiscal conservatives who argue that raising the debt ceiling without addressing spending is irresponsible. These debates can cause delays and, in extreme cases, even a government shutdown or a default. How the debt ceiling crisis affects the US economy and you. One of the biggest fears during a debt ceiling crisis is that the government could default on its debt. A default means the US government doesn't have the funds to pay back its debt obligations on time. If that happens, it could lead to a domino effect. Stocks could plummet, interest rates might rise, and inflation could spiral out of control. This would directly affect your savings, your investments, and your ability to access credit. When there's uncertainty about whether the government can continue borrowing money, the stock market tends to get nervous. Investors start to sell off stocks, causing stock prices to fall. And while the stock market can be volatile at times, a debt ceiling crisis is a special kind of turmoil. Companies that depend on government contracts or subsidies could see their profits drop, which will ripple through the economy. One of the most direct impacts of a debt ceiling crisis on your personal finances is through higher interest rates. When the government borrows money, they usually do so by issuing treasury bonds. If the government defaults, or even comes close to it, the market will demand higher interest rates to lend the government money. This increase in borrowing costs won't just affect the government, it will affect you too. Your mortgage rates, credit card interest rates, car loans, and personal loans could all rise as a result of higher interest rates. That means more of your money will go towards paying interest instead of building savings or paying down debt. It's a lose-lose situation. Another aspect of a debt ceiling crisis is the potential cutbacks in social programs. These programs, such as Social Security, Medicare, and unemployment benefits, depend heavily on government funding. If the government faces a shutdown or an inability to borrow more money, these programs could be temporarily suspended or reduced. As inflation continues to eat away at your purchasing power, the last thing you need is an economic crisis to wipe out your hard-earned savings. A debt ceiling crisis could impact banks, leading to concerns about the safety of your deposits. While the FDIC insures deposits up to a certain amount, the economic uncertainty could trigger panic withdrawals or limit access to funds. Investing during a debt ceiling crisis is tricky. Stock markets may be volatile, and bonds could become less reliable. But this doesn't mean you should just pull your money out and hide it in a safe. In fact, a smart investor understands that while short-term volatility might increase, long-term investment strategies often outperform. We'll discuss ways to hedge against these risks by diversifying your investments across various asset classes, including gold, real estate, and international stocks. How to protect yourself financially during a debt ceiling crisis. One of the best ways to protect yourself in uncertain times is by building an emergency fund. This will act as your safety net when things go south. Ideally, you should aim for 3 to 6 months of living expenses in a savings account that's separate from your regular checking. In times of economic uncertainty, it's wise to focus on paying down high-interest debt. With potential interest rate hikes looming, reducing your credit card balances and loans can help you avoid becoming trapped by escalating payments. Don't put all your eggs in one basket. If you rely solely on stocks or bonds, you're vulnerable to the risk that a debt ceiling crisis could cause them to tank. Consider spreading your investments across different asset classes, such as real estate, commodities, and even international stocks that are less likely to be affected by US government issues. Remember that markets will bounce back. If you panic sell during a downturn, you're likely to lock in losses. The key is to stay calm, stick to your long-term investment strategy, and avoid making emotional decisions. We've covered a lot of ground today, from understanding the debt ceiling to discussing its potential impact on your savings, investments, and everyday life. A debt ceiling crisis can seem far removed from your day-to-day concerns, but as we've seen, it has the power to directly affect your finances. If you found this video helpful, please give it a thumbs up and don't forget to subscribe to Wallet Vision. Also, check out my previous video on understanding US inflation and how to protect your money, where we talk about managing inflation's impact on your savings and investments. You can find the link in the description below. Remember, the key to financial freedom is knowledge and preparation. Stay informed, stay proactive, and always plan ahead for the unexpected. Thanks for watching, and I'll see you in the next one.